Assalamualaikum. Today we discuss about how interest rate affect the housing market. Mortgage loan comes into primary forms, fixed rate and adjustable rate, with some hybrid combinations and multiple derivatives of each. A basic understanding of interest rate and the economic influence that determine the future courses of interest rate can help you to make financially sound mortgage decision. So decision include choosing between fixed rate mortgage and an adjustable rate mortgage, or deciding whether they refinance out of ARM, means adjustable rate mortgage. Key takeaways: understanding interest rate is key to making financially sound mortgage decision. The interest rate is the amount of borrower is charged for the privilege to being loan money. Interest rate on mortgages are determined by a number of factors, includes the state of general economy and your personal circumstance. Mortgage lenders often peg their interest rate to the 10-year treasury bond yield. Looking at the shape of yield curve can help when trying to forecast interest rate change on ARM. How are interest rate determined? The interest rate is the amount charged on top of the principal by a lender to a borrower for the use of assets. The interest rate change charged by banks is determined by a number of factors, such as the state of economy. A country's central bank sets the interest rate, which each bank uses to determine the range of annual percentage rates they offer. Central banks tend to raise interest rate when inflation is high, because higher interest rate increase the cost of debt, which discourages borrowing and slows consumer demand. The mortgage production line. The mortgage industry has three primary parts of businesses: the mortgage originator, an aggregator, and investor. The the mortgage orienter is the lender. Lenders some come in the several forms like credit union and bank. Mortgage origination introduce market and well loan of consumers and compete with each other based on the interest rate, fees, and service level that they offer. The interest rate and fees they charge determine their profit margin. Most mortgage orientators do not portfolio loans, meaning that they do not retain the loan asset. Instead, they often sell the mortgage into the secondary mortgage market. The interest rates that they charge consumers are determined by their profit margin and the price at which they can sell the mortgage into the secondary mortgage market. The aggregator. The aggregator buys newly oriented mortgage from other institutions. They are part of the secondary mortgage market. The most of them are also mortgage oriented. Aggregator pool many similar mortgages together from mortgage-backed securities, a process known as securitization. MBS is a bond held by an underlying pool mortgages. MBS are sold to investors. The fees at which they can be sold to investors determine that fees that aggregator will pay off newly oriented mortgage from other lenders, and the interest rate that they offer to consumers for their own mortgage orientation. The investor. There are many investors in MBS, including pension funds, mutual funds, banks, hedge funds, foreign governments, insurance companies, and government sponsored enterprises. As investors try to maximize return, they frequently run relative value analysis between MBS and other fixed income investments such as corporate bond. As with all financial securities, investor demand for MBS determine the price they will pay for these securities. Investor impact on mortgage rate. To large degrees, MBS investors determine to mortgage rates offered consumers, as explained above. The mortgage production line ends in the form of MBS purchased by investors. The free market determines the market clearing price. Investors will pay for MBS. These price wind their way back through the mortgage industry to determine the interest of rate you will offer when you buy your house. Fixed interest rate mortgage. The interest rate on fixed rate mortgage is fixed for the life of the mortgage. However, average 30-year fixed rate mortgage have a shorter lifespan due to consumers moving or refinancing their mortgage. The rule of thumb used to be that homeowners stayed in their home as average of 7 years. However, that figure has been rising according to survey from real estate brokerage Redfin, and average homeowners had been their home for 13 years in 2020, up to 8.7 years in 2010. What's more, according to 2020 report by the National Association of Realtors, nearly half of home buyers said that they expected to stay in their home for 16 years or more. MBS prices are highly correlated with the price of US Treasury bonds. Usually, the price of MBS backed by 30-year mortgage will move the price of US Treasury 5-year notes or US Treasury 10 years bond based on financial principle known as duration. In practice, a 30-year mortgage duration is closer to 5-year notes, but the market tends to use the 10-year bond in benchmark. They also mean that interest rate on 30-year fixed rate mortgage offered to consumer they should move up to down with the yield of the US Treasury 10 years bond. A bond yield is a function of its coupon rate and price. Economic expectation determine the price and yield of US Treasury bond. A bond's worst enemy is inflation, which erodes the value of future bond payment, both coupon payments and repayment of principal. Therefore, when inflation is higher, expected to rise bond price fall, which mean their yield rise. There in inverse relationship between bond price and its yield. The Fed's role. The Federal Reserve Fed plays a large role in inflation expectation. This is because the bond market's perception of how will the Fed is controlling inflation through the administration of short-term interest rate determine longer interest rates such as yield of US Treasury 10 years bond. In other words, the Fed sets current short-term interest rates which the market interrupts to determine long-term interest rates such as the yield of US Treasury 10 years bond. Adjustable rate mortgage. The interest rate in the adjustable mortgage rate might change monthly, every 6 months, annually, or less than, often depending on the terms of the mortgage.